This is our third video in the financial statements videos where you are creating income statements, balance sheet, and statements of cash flows to get a better understanding of what's in these statements. We've looked at the income statement, we've looked at the balance sheet breakdown, and what we're going to do here today is we're going to take a look at the account type. First, we're going to find internal and external financing accounts. So what are the internal financing accounts? Those are from money internally generated. Internally generated meaning from the business. Pause for a moment and think about it. The answer is internally generated account is retained earnings. And it's coming from the income statement and gets reinvested into the company back by showing up on the balance sheet, the money being added back and reinvested into the business. So the internally generated financing is coming from retained earnings, earnings retained from the sale of your shirts minus the costs. So what are the external financing accounts? Money that the company has access to from outside sources. Well, those are going to be accounts related to debt and equity. So your external financing accounts are going to be short-term debt, long-term debt, and common stock. Because you can borrow from a bank or from the bond market externally, and you can bring in external owners as they infuse new capital into the company. So short-term debt, long-term debt, and common stock. Because interest is paid on short-term debt, interest is actually an account that is related to external financing. So we'll go ahead and say here external related. Another account that's related to external financing is a dividend. And we can go ahead and call it just a financing account for now and come back in a moment to it. We have figured out internal financing accounts, retained earnings, and external financing accounts, short-term debt, long-term debt, and common stock. Next, we're going to break down income statement and balance sheet account into operating, investment, and financing accounts, because that will help us understand operating, investment, and financing activities on the statement of cash flows, and in general understand how these accounts flow. So to help with that, first, let's see how operating activities on the statement of cash flows are calculated. We will usually take the net income from the balance sheet and adjust it, usually meaning add depreciation from the income statement back to it, because we want to see operating cash flows, and depreciation is a non-cash expense. This is further adjusted by all operating accounts from the balance sheet. And because it's a balance sheet, we need to look at the difference in these accounts. Operating accounts on the balance sheets are those needed for day-to-day business operations. And there at the very base are going to be inventories, because you need inventories when you're selling shirts. Accounts receivable, you need to give credit to customers as you sell shirts. And accounts payable, you need credit from suppliers to have the material for your shirts. So the operating accounts on the balance sheet are going to be inventory, accounts receivable, and accounts payable. You need these for day-to-day business operations. These are also referred to as operating net working capital or operating working capital account. So I will go ahead and add that information there to operating working capital, OWC, operating working capital, or operating net working capital accounts. They are needed for day-to-day business operations. Of course, we see that net income is also an operating account, right? That's the first thing that's going to be accounted for. So you can say operating with depreciation adjustment. Next, we're going to take a look at the investment accounts. Investment accounts are at the heart of the company, so I'm going to color them red to reflect that being at the heart of the company. Each company, depending on their business model, invests in different types of assets. So if you're making shirts, you're going to buy sewing machines and build factories for sewing machines. If you make cars, you will buy equipment that makes mold for cars and have factories that are specific to that. So business investment is at the heart, that's the decision at the heart of the business. What does it invest in? And it represents it's investment into equipment and factories. So as such, the investment is usually calculated as the change in net fixed assets from the balance sheet that is going to be further adjusted by income statement depreciation. Why are we adjusting net fixed assets by depreciation? Because this depreciation is netted out, taking out of your net fixed assets. And to record the correct expenditure on equipment, you need to bring that in to know exactly how much money you spent. So it's no secret that the investment account on the balance sheet is going to be the property, plant, and equipment account. This is, again, at the heart of all of the firm's decisions. Let's make it all red. And I'll oftentimes say that it's at the heart of the firm's decisions. The investment decision right here, which equipment, which factories does the company create in order to support their products. And finally, we want to find the financing accounts. So financing cash flows are calculated as dividends that are adjusted by the change, because now we're going to be drawing from balance sheet account in balance sheet external financing accounts, which is going to be notes payable or short-term debt, long-term debt, and common stock. Okay, so the financing accounts are going to be dividend. We already wrote that down. Also short-term debt, we'll just add it here. Long-term debt and common stock. Excellent. We are done identifying the account types, but let's go ahead and create a little bit of a review. So here, let's create a review. If somebody is going to ask you, well, can you tell me what are the internal funding accounts on your financial statements? Well, those are going to be, take a moment to think, retained earnings. And then what if somebody asks you, well, what about external financing accounts from the income statement and the balance sheet? What are those? These are accessed funds outside of the company, not internally generated from selling your business items. These are going to be short-term debt, long-term debt, and common stock. Of course, interest is the related account because interest is paid on either short-term debt or long-term debt. Finally, somebody might ask you, well, can you name operating balance sheet accounts? And these are also the same as operating working capital accounts. These are going to be inventories, accounts receivable, and accounts payable. You need to have inventories of your shirts. You need to give credit to your customers and have credit from your suppliers to operate the business day to day. And finally, somebody might ask you, well, what is the investment balance sheet accounts? And here you're going to look at the net fixed assets. Of course, when we're looking at balance sheets and we want to understand what's happening in an account, we need to differentiate those accounts because balance sheet are cumulative statements. And this completes our split of accounts into account type and a quick review of what we've done.